Hess Midstream IPO'd in 2017. Let's see why my discounted cash flow model says the stock is currently undervalued. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Hess Midstream stock by analyzing their financial ratios and dissecting their financial statements, so we can determine if the stock is a buy or a sell. Hess Midstream IPO'd in 2017. It is a subsidiary of the S&P 500 company Hess, ticker HES. Hess Midstream is an oil and gas midstream company. Midstream refers to points in the oil production process that falls between upstream and downstream. Midstream activities include the storage, processing, and transportation of petroleum. Let's get started with the model. This is a small company, $319 million market cap. They're trading at $17.70 a share. And to get shares outstanding, it's market cap divided by stock price gives you shares outstanding 18 million. Let's look at the financials. Free cash flow is how you value a company. You estimate the future free cash flows and then discount that number back to today's value. That's what we're doing in this video. And free cash flow equals cash flow from operations minus capital expenditures. CapEx is investment in property, plant, and equipment. If a company has positive free cash flow, it makes it a lot easier for them to pay down debt, pay dividends, acquire other companies, or invest back into their business to grow it. If a company has negative free cash flow, it might not be able to do any of those things. And this company seems to have positive and pretty consistent free cash flow each year. Net income is the profit and loss on the income statement. It's revenue minus expenses. And their net income also looks pretty good year to year. Revenue is top line of the income statement. It's the sales for the company. And their revenue grows each year. It looks like they're moving in the right direction, and they have really solid margins, 37% to 56%. I consider a profit margin above 20% really good, so they're doing great at converting revenue into income. Net profit margin is net income divided by revenue. In 2019, they converted 37% of their revenue into net income, which means 63% went towards expenses. Let's look at the financial statements. The top line of the income statement is revenue. Below that is cost of revenue. So you can see the revenue grows each year and the cost of revenue grows each year. But it's hard to look at nominal numbers to see whether the cost of revenue is growing at a faster or slower pace than revenue. So we need to look at it as a percent of revenue. Same thing with operating expenses. Let's look at that as a percent of revenue. The cost of revenue represents the costs involved in making and delivering your company's product or service to a customer. For example, if you make and sell a physical product, the raw materials, labor, factory costs like utilities and equipment, shipping costs, etc. are included in cost of revenue. For a service company, the salaries of the service providers and any other costs associated directly with providing the service is a cost of revenue. Certain industries have a higher cost of revenue than other industries. When revenue goes up, it is expected that economies of scale set in and the company becomes more efficient. You would expect cost of revenue as a percent of revenue to decrease as sales increase. If that is not the case, then this is something to look into as an investor. In 2016, about 20% of their revenue went towards cost of revenue. Same thing in 2017, but it did drop in 2018 and dropped again in 2019. So you can see the sales were increasing, but the cost of revenue as a percent of revenue decreased, which is what you want to see. The larger you become as a company, the more efficient you should become because you can buy products for cheaper because you could buy in mass quantity. You could also streamline some activities. An operating expense is an expense a business incurs through its normal business operations. It includes rent, marketing, supplies, payroll for support functions like accounting and legal, insurance, research and development costs, and many more. Operating expenses are necessary and unavoidable for most businesses. Some firms successfully reduce operating expenses to increase earnings. Reducing operating expenses can also compromise the integrity of your business. Finding the right balance can be difficult, but can yield great results. Certain industries have higher operating expense than other industries. As we discussed earlier with cost of revenue, you would expect a company to become more efficient when revenue increases, but this may not always be the case with operating expenses. As we know, their revenue increased year to year, but their operating expenses did improve in 2016 to 2017 and again in 2018, but they jumped back up in 2019. The big jump in operating expenses in 2019 were due to restructuring costs. So to go back to the income statement, revenue is top line, then cost of revenue, then the difference between those two is the gross profit. Then you have operating expenses, and the difference between gross profit and operating expenses is your operating income. If you see a company with negative operating income for a long stretch of time, they will eventually go out of business. Below that is the interest they pay in their debt. Also, it's the interest they receive on their investments. And if this number is larger than operating income, then that means a company may need to take on more debt just to run its day-to-day operations. Below that is other, because some companies generate money or lose money outside of their day-to-day operations. They reported a $3.4 million gain from earnings from equity interest. Let me show you what that is. This is from the 10K. Equity method is an accounting technique to record profits when a company has significant influence over another company. When a company holds 20% to 50% of another company's stock, it is considered to have significant influence. For example, if this company owned 40% of Company X and Company X reported $100 of net income, and since this company owns 40% of Company X, it would report $40 onto its income statement as a gain. This is different from cost accounting, where if the company owned less than 20% of another company, it would only report the dividends it received from that company. For example, if this company owned 10% of Company X, and Company X paid $200 in dividends, and since this company owns 10% of Company X, it would report $20 on its income statement as a gain. So everything looks pretty clean and normal on their income statement. Let's look at their statement of cash flows. To calculate free cash flow, you take cash flow from operations. In 2019, it was $470 million, minus CapEx. It was $306 million. That gives you $164 million of free cash flow. To calculate cash flow from operations, you start with net income, and then you add back the non-cash items from the income statement. Depreciation and amortization is usually the highest non-cash item on most companies' cash flow statement. And then you have to adjust for working capital. Working capital changes in accounts receivable, accounts payable, inventory, things like that. The statement of cash flows looks pretty good. Nothing jumps out at me. All the numbers are positive and pretty consistent. Let's look at a capital structure. $1.8 billion of debt, $1.3 billion of equity. And the interest rate they pay in their debt is 3.56%. And they don't pay taxes because they're a master limited partnership. To qualify as an MLP, a company must generate at least 90% of its revenue from natural resources or real estate. They have 57% debt in their capital structure, which means they have 43% equity. Cost of equity is 22.13%. To calculate cost of equity, we use the capital asset pricing model. And part of the CAPM formula is the beta. And they have a really high beta, so their stock is pretty volatile, 2.58. Beta is a measure of a stock's volatility in relation to the overall market. The S&P 500 has a beta of 1. This stock has a beta of 2.58, so if the S&P goes up 1%, this stock should go up on average about 2.5%. And if the S&P goes down 1%, this stock should go down around 2.5%. Beta is calculated using regression analysis. Regression analysis allows you to examine the relationship between two or more variables. Beta is systematic risk related to the market, like interest rate changes, policy changes, wars, etc. Systematic risk cannot be diversified away. Unsystematic risk is the risk of an individual company, which can be diversified away by adding more stocks to your portfolio. And their WACC is 11.58%, which is a blend of the cost of debt and cost of equity. And the WACC is a discount rate companies use when they want to take on new projects. For example, if a new project came along that cost this company $1 million up front, and the project would generate $100,000 of profit for each year, the company would discount those 20 years of cash flows back to today's dollars using the weighted average cost of capital. If the present value of the future cash flows equaled $1.4 million, the company would take on the project since it cost them $1 million. They would make a $400,000 profit. But if the present value of the 20 years of cash flows equaled $800,000, then the company would not take on a project since it cost them $1 million. They would be losing $200,000. You only want to take on projects that add value to the company. The WACC is a discount rate we're going to apply to the future cash flows for this model. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $584 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1 billion. We divide that by 18 million shares. And we get a calculated stock price of $56.01. They're trading at $17.70, so they're trading at a 68% discount. It's a really strong buy according to the model. Simply Wall Street is also saying the stock is undervalued, just not as much as me. They're saying the value is $31.87. Simply Wall Street's valuation is based off of the average analyst estimate. Let's see where the stock has been trading the past few years. You can see it started trading in 2017, so it's been a little over 3 years since they IPO'd. And their stock price was pretty steady for a while, then took a really big dip at coronavirus, and it's come up a lot. So if you bought at the dip, you'd be making a pretty nice return. So the stock is much lower than its all-time high, so it looks like it could have great potential, and it's underneath Hess, which is a massive oil and gas company. Let's look at their dividend payments. They started out at a 27-cent dividend, and it's only gone up. It went up from 27 cents all the way up to 44 cents. They've never cut their dividend, and they pay almost a 10% dividend yield. So they're doing it the right way. They started with a low dividend and just kept increasing it little by little. Lots of investors, especially people who invest in these types of companies, look for the dividend payments. And a company that doesn't cut their dividends is a company they generally like. The dividend yield is annual dividend payment, so it's last 4 quarters over stock price. So as the stock price goes down, the dividend yield goes up. And as the stock price goes up, the dividend yield goes down. It is good to remember that a company's financial performance is not 100% correlated to changes in the stock price. It can help or hurt the stock price. The only thing that is directly correlated to the stock price is supply and demand of the market. The stock price will go up if there are more buyers than sellers. The stock price will go down if there are more sellers than buyers. It is possible for a company to report great financials and its stock price keeps going down. It is also possible for a company to report weak financials and the stock price keeps going up. The market is forward thinking. Part of investing in the stock market is understanding market sentiment and investor psychology, which can be the hardest things to figure out. In the short run, no one can predict the stock market. But if you invest in solid companies with good fundamentals and hold long term, you should be better off than most investors. The reason I like focusing on financials is because all the information is there. If you listen to others, they can spin their narrative to make the company look great or look terrible. Let's look at the financial ratios. They have really great price multiples. The median PE in the market is 15.9 and the average is 17.7. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15. They're at 1.0. So investors are paying $1 for $1 of earnings. The median price of sales is 2.0. The average is 4.6. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5. They're at 0.4. So investors are paying 40 cents for $1 of revenue. The median price to book is 2.3. The average is 4.8. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5. They're at 0.2. So investors are paying 20 cents for $1 book value. Equity is total assets minus total liabilities on the balance sheet. They have a good interest coverage ratio. The median is 4.0. The average is 12.9. Interest coverage ratio is EBIT over interest expense. I like to see above 2. They're at 6.0, so they can easily cover their interest payments. EBIT is earnings before interest and taxes, also called operating income on the income statement. ROE is really good. The median is 12%. The average is 13%. ROE is net income over equity. I like to see above 20%. They're at 24%. They have a bad current ratio. The median is 1.3, the average is 1.8. Current ratio is current assets over current liabilities, so they can only cover half their current liabilities. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables due within 12 months. Examples are current debt and accounts payable. The best way to look at ratios to compare them to similar companies, I've done videos on 32 oil and gas midstream companies, and Hess is right here. And if Hess has a number in green, they're better than the average. Average is over here. And if they have a number in red, they're worse than the average. So they have the best PE of all the companies at 1.0. They're much better than average in price to sales, and they have the best price to book of all the companies at 0.2. Current ratio isn't good, they're at 0.5, but this could be a timing thing, so possibly next quarter or next year they'll fix this. ROE, they're much better than the average. They have lower debt than the average. They're a really small company. They're one of the smallest on this list. And their dividend, even though they pay a good dividend, 9.86%, they're lower than average because this industry pays massive dividends. DHT pays almost a 36% dividend. To summarize, I have them trading at a 68% discount. Their ratios look great and their financials look really good as well. Let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, receive a custom valuation, or support the channel, you can become a member by clicking on the link in the description below. Every month, I will provide my members with an Excel file to help them better analyze stocks. Thanks for watching.